There are moments in markets when certainty becomes a dangerous illusion. We all want to know what will happen tomorrow, which asset will rise, when the correction or rally will arrive. But the truth is far more uncomfortable. Nobody knows. Not central banks, not the largest fund managers, not the brightest minds on Wall Street. And yet, there is a way to position yourself that doesn't require predicting the future. A way that protects you when everything falls apart and allows you to capture extraordinary gains when things explode to the upside. It's called the barbell strategy. And in the context of precious metals, it could be the difference between surviving and thriving in what's coming. The core idea is simple but profound. Instead of trying to nail a single prediction, you build a portfolio with two well-defined extremes. On one side, you hold ultra-safe, defensive assets designed to protect you in scenarios of collapse, deflation, or systemic crisis. On the other, you hold asymmetric exposures, bets with limited risk but explosive upside potential. And in the middle, nothing. You eliminate the noise. You eliminate the lukewarm assets that neither protect you nor give you real optionality. This structure isn't passive. It's active in its design, but resilient in its execution. It doesn't depend on being right about timing. It depends on being prepared for multiple outcomes.
If this kind of analysis helps you see the market from a different angle, subscribe now and join us for the next reports and alerts.
What we're building here is a framework for navigating uncertainty without gambling on a single scenario. Now let's talk about why this matters right now, especially for metals. We are living through a period of extreme tension in the global financial architecture. Debt levels have reached historic highs. Central banks are trapped between fighting inflation and preventing economic collapse. Currencies are being debased at an accelerating pace. Geopolitical fractures are widening. And trust in institutions, in governments, in the very concept of money as we've known it, is eroding faster than most realize. In this environment, traditional portfolios are vulnerable. A standard 60-40 allocation, stocks and bonds, assumes a world of stability, predictable growth, and central banks that can always step in to save the day. But what if that world is ending? What if the next crisis doesn't respond to the playbook? What if the tools that worked for decades suddenly stop working? That's where metals come in. Gold and silver have always been the assets of last resort, the stores of value that survive when paper promises fail. But here's the key. Not all metal positions are created equal. Some are purely defensive, others are speculative, and the barbell strategy allows you to hold both without contradiction. You're not betting on one outcome, you're preparing for a range of outcomes, and you're doing it in a way that limits your downside while preserving massive upside potential. Let me break down how this works in practice. On the defensive side of the barbell, you hold physical gold, not paper gold, not ETFs that carry counterparty risk, but actual metal in your possession or in secure allocated storage. This is your fortress. This is what protects you when currencies collapse, when banks fail, when the system itself comes under question. Gold has no default risk. It's no one's liability. It doesn't depend on a government's promise or a central bank's credibility. It just is. And in a world where promises are breaking down, that matters more than ever. The allocation here should be meaningful enough to make a difference. If you only hold 1 or 2% in physical gold, it's not going to move the needle when things go wrong. You need enough that if fiat currencies lose 20, 30, 50% of their purchasing power, your gold position absorbs that shock and keeps your wealth intact. For most investors, that means somewhere between 10 and 20% of total portfolio value. It's not about maximizing returns. It's about ensuring survival. It's about having something real when everything else turns out to be fiction. But here's where most people stop. They build the defensive side and then they sit there waiting, hoping that the crisis comes so their goal goes up. That's a mistake. Because while you're waiting, you're missing the other half of the equation, the optionality side, the asymmetric bets that can turn a modest allocation into life-changing wealth if the conditions align, and that's where silver comes in. Silver is different from gold. It's more volatile, more industrial, more speculative. It doesn't have the same reserve status or the same institutional recognition. But that's exactly what makes it powerful in a barbell structure. Silver is the high beta play on monetary distrust and industrial demand. When gold moves, silver often moves further. When inflation expectations rise, silver reacts more sharply. When supply constraints meet surging demand, silver can explode in ways that gold never will. It's smaller, thinner, and far more reactive. And that's the point. You don't need silver to protect you. That's what gold is for. You need silver to capture the upside when the monetary regime shifts. On the optionality side of the barbell, you allocate to physical silver, silver mining stocks, and potentially leverage instruments like options or futures if you have the sophistication and risk tolerance. This allocation should be smaller than your gold position, maybe 5 to 10%, because the volatility is higher and the downside can be sharp. But the key is that your risk is defined, you know what you're putting in, and you know that if it goes to zero, it won't destroy you. But if it goes up 5 times, 10 times, or more, it transforms your wealth. This is the essence of asymmetry. You're not betting big on a single outcome. You're making a controlled bet where the potential gain far outweighs the potential loss. And when you combine that with the defensive side, the goal that protects your base, you create a structure that can withstand shocks and capitalize on opportunity at the same time. You're not hoping for one scenario, you're prepared for many. Now let's go deeper into why this structure works so well in the current environment. The mistake most investors make is thinking in terms of binary outcomes, either inflation or deflation, either growth or recession, either the dollar strengthens or it collapses. But reality is messier. We could see inflation in some areas and deflation in others. We could see currency strength in the short term and weakness in the long term. We could see violent swings in both directions as policymakers lurch from one crisis to the next. The barbell strategy doesn't care. It's built to handle volatility, to thrive in uncertainty, to benefit from extreme moves in either direction. Think about it this way. If we get deflation, a debt collapse, a financial crisis, your physical gold holds its value or rises as people flee to safety. Your silver might get hit in the short term, but because your allocation is modest and your downside is capped, the damage is contained. Meanwhile, your gold is doing exactly what it's supposed to do, preserving your purchasing power. Now, flip the scenario. If we get high inflation, currency debasement, a loss of confidence in fiat money, your gold rises, but your silver potentially explodes. The industrial demand kicks in, the monetary hedge demand kicks in, and the thin market structure amplifies the move. Your optionality side delivers returns that far exceed what gold alone could ever provide. And here's the beautiful part. You didn't have to predict which scenario would happen. You didn't have to time the market. You didn't have to be right about the Fed's next move, or the exact path of inflation, or the precise moment when trust collapses. You just had to be positioned for the range of possibilities. And that's what resilience looks like. It's not about being right. It's about being prepared. But there's more to this strategy than just holding 2 buckets of metal. The real power comes from understanding the dynamics between them and knowing when to adjust. The barbell is not static. It's a living structure that responds to changing conditions. When volatility is low, when complacency is high, when everyone assumes the status quo will continue, that's when you build the position. That's when premiums are reasonable, when physical metal is available, when sentiment is weak. You accumulate quietly, without fanfare, without trying to catch the exact bottom. Then, when the shock comes, and it always comes, you don't panic, you don't sell at the worst moment, you hold the defensive side because that's what it's there for. And you watch the optionality side carefully. If silver surges into a parabolic move, if mining stocks start multiplying in value, that's when you consider taking profits. Not all of it, but enough to lock in gains and rebalance. You might shift some of those profits back into the defensive side, increasing your gold position. Or you might redeploy into other asymmetric opportunities. The point is, you're managing the structure dynamically, not religiously. One of the most common mistakes I see is that people build a barbell and then forget about it. They set it and walk away. But markets evolve, risks shift, opportunities emerge and disappear. You have to stay engaged. You have to reassess your positioning as conditions change. That doesn't mean trading constantly or reacting to every headline. It means having a framework and applying it consistently. It means asking yourself regularly, where are we in the cycle? What are the probabilities? What does my barbell look like right now? And does it still reflect the reality I'm facing? Let's talk about the middle, the part you're deliberately leaving empty. In a traditional portfolio, you'd fill this space with moderate risk, moderate return assets. Corporate bonds, dividend stocks, balanced funds, real estate investment trust. The stuff that's supposed to give you steady income and modest growth. But here's the problem. In a world of extreme outcomes, moderate risk assets often deliver the worst of both worlds. They don't protect you in a crisis, and they don't give you explosive upside in a boom. They just sit there, mediocre, vulnerable, and uninspiring. The barbell strategy says eliminate that middle. Don't hold assets that don't serve a clear purpose. If something isn't either defending your wealth or giving you asymmetric optionality, why hold it? This is a controversial stance, and it's not for everyone. If you need income, if you have near-term liabilities, if your psychology can't handle the volatility of the extremes, then you might need some middle ground. But for those who can tolerate it, who understand the logic, removing the middle sharpens your focus and concentrates your resources where they matter most. It's worth noting that this isn't about being reckless. The defensive side is there precisely to prevent recklessness. You're not swinging for the fences with your entire portfolio. You're protecting your base, ensuring survival, and then using a defined portion to capture upside. That's discipline. That's prudence. That's how you navigate uncertainty without gambling. Now let's address a critical element that often gets overlooked, the psychological dimension. Holding a barbell portfolio requires a different mindset than traditional investing. You have to be comfortable with extreme positions. You have to accept that one side might do nothing for years while the other sits quietly waiting. You have to resist the temptation to fiddle, to chase performance, to abandon the structure when it feels like it's not working. This is hard. Human beings are wired to seek validation, to want immediate feedback, to feel like they're doing something. The barbell often feels like you're doing nothing, or worse, like you're doing the wrong thing. But that discomfort is often a sign that you're positioned correctly. When everyone else is chasing the hot trade, when the consensus is certain, when the market feels safe, that's when your barbell looks strange. And that's exactly when it's most valuable, because the crowd is always wrong at the extremes. The crowd buys at the top and sells at the bottom. The crowd abandons defense when it's needed most and chases speculation when it's most dangerous. The barbell keeps you out of that trap. It forces you to think independently, to act based on structure rather than emotion. Remember, this content is educational and not financial advice. Its goal is to help you think more clearly about your decisions. What I'm offering here is a framework, a way of thinking, not a prescription. Your circumstances, your risk tolerance, your time horizon, they're all unique. But the principles are universal. Protect your downside, capture your upside, and don't pretend you can predict the future. Let's talk about the practical mechanics. How do you actually implement this? Start with the defensive side. Determine how much of your portfolio you're willing to allocate to physical gold. This should be a number that lets you sleep at night, knowing that if everything else goes wrong, you still have something real. Then acquire it. Buy physical bars or coins from reputable dealers. Store them securely, either in a safe at home or in allocated storage with a trusted custodian. Avoid unallocated accounts where you're just a creditor. Avoid ETFs with complex structures and counterparty risks. Keep it simple, keep it real. Next, build the optionality side. Decide how much you're willing to allocate to higher risk, higher reward plays. This is where silver comes in. Start with physical silver if you want the simplest approach. Coins, bars, rounds, whatever, gives you exposure to the metal itself. If you're more sophisticated, consider silver mining stocks. These offer leverage to the silver price, meaning they can move 2, 3, 5 times as much as the metal itself. But they also carry operational risks, management risks, geopolitical risks. Do your homework. Diversify across multiple companies if you go this route. For those with even higher risk tolerance and experience, options on silver futures or mining stocks can provide asymmetric payoffs. A small allocation to out-of-the-money call options, for example, can deliver exponential returns if silver surges. But these are speculative instruments. They can and often do expire worthless. That's the nature of optionality. You're paying a premium for the chance at a massive gain. If you don't understand how options work, don't use them. Stick with physical metal and stocks. Once you've built both sides, document your allocation. Write it down. Know exactly what you own, why you own it, and what conditions would cause you to adjust. This isn't about rigid rules. It's about having a plan so you're not making decisions in the heat of panic or euphoria. When silver doubles in price, you'll be tempted to buy more. When it crashes, you'll be tempted to sell. Your documented plan keeps you grounded. It reminds you of the logic, the structure, the purpose. And then you wait, not passively, but patiently. You monitor conditions. You watch central bank policy, inflation data, currency movements, geopolitical developments. You stay informed, but you don't react to every piece of news. You're looking for the big shifts, the structural changes, the moments when the probabilities tilt decisively. And when those moments come, you act, you rebalance, you take profits, you add to positions. But you do it from a position of strength, not desperation. One of the most powerful aspects of the barbell strategy is that it allows you to benefit from volatility rather than fear it. Most investors hate volatility. It stresses them out, makes them second guess their decisions, tempts them to sell at the worst times. But volatility is the friend of the barbell holder. When markets swing wildly, when prices gap up or down, when fear and greed alternate rapidly, your structure captures those moves. Your defensive side dampens the downside. Your optionality side amplifies the upside. You're not trying to avoid volatility. You're designed to exploit it. This is especially important in metals, where volatility is a feature, not a bug. Gold can be relatively stable for long periods and then surge 20 or 30% in a matter of months. Silver can do that in weeks, Mining stocks can move even faster. If you're positioned with a barbell, those surges don't scare you. They excite you because you know you're capturing them on the optionality side while your base remains protected. You're not all in on a single bet. You're diversified across outcomes. Now let's zoom out and think about the bigger picture. Why does this strategy matter beyond just metals? Because the principles apply broadly. The barbell is a way of thinking about risk and reward in any domain. It's about avoiding the middle, the mediocre, the false sense of safety that comes from compromise. It's about embracing extremes in a disciplined way. And in a world that's increasingly characterized by extremes, political polarization, monetary experimentation, technological disruption, climate shifts, this way of thinking becomes essential. The old playbook assumed a world of gradualism, of mean reversion, of predictable cycles. But we're entering a phase where the tails are getting fatter, where the extreme events are happening more frequently and with greater magnitude. In such a world, portfolios built for the average outcome will get crushed. Portfolios built for the extremes will thrive. The barbell is how you build for the extremes without recklessness. And here's something most people don't appreciate. The barbell isn't just about financial assets. You can apply the same logic to your career, your skills, your network, have a stable base, something that provides security and steady income, and then have moonshots, projects, or investments with asymmetric upside. Don't waste time on the mediocre middle, the jobs that pay okay but lead nowhere, the skills that are neither essential nor transformative. Focus on the extremes. That's where value is created in an age of disruption. But back to metals. The reason I'm so focused on this strategy in the context of gold and silver is because we're at a historical inflection point. The monetary system, as we've known it for the past 50 years, the era of pure fiat currencies, unlimited credit expansion, central bank dominance, is under strain. The cracks are visible. The debt is unsustainable. The trust is eroding. And when systems break, they don't do so gradually. They break suddenly, violently, and in ways that catch the majority off guard. Gold and silver are the assets that have survived every previous monetary transition. They've outlasted empires, currencies, governments, ideologies. They're not relics, they're constants. And in the transition we're entering, they will once again prove their worth, but only if you position correctly, only if you build a structure that can withstand the shocks and capture the opportunities. That's what the barbell gives you. Let me tell you what happens if you don't have this structure. If you're all in on equities, you're vulnerable to a market crash, a prolonged bear market, or a scenario where stocks go up in nominal terms but lose value in real terms because of inflation. If you're all in on bonds, you're vulnerable to rising rates, inflation, or default. If you're all in on cash, you're guaranteed to lose purchasing power over time. And if you're all in on speculative plays, you're exposed to total loss if the trade goes wrong. None of these positions give you both defense and optionality. They're one-sided bets. And one-sided bets are fragile. The barbell eliminates that fragility. It gives you resilience on one side and explosiveness on the other. It's the portfolio equivalent of anti-fragility, the concept that some things benefit from disorder. Your defensive side doesn't break when chaos hits. Your optionality side thrives on it. Together, they create a portfolio that's stronger under stress than under calm. And stress is coming. Maybe it's already here. Look at the signals. Central banks are struggling to control inflation without triggering recession. Governments are running deficits that can only be financed by printing more money. Geopolitical tensions are rising trade wars, sanctions, military conflicts, supply chains remain fragile, energy prices are volatile, and trust in institutions is at historic lows. These aren't minor issues. They're systemic fractures. And when systems fracture, assets bifurcate. Some collapse, others soar. The barbell ensures you're on the right side of that bifurcation. Now let's talk about timing, or rather, the lack of need for it. One of the biggest advantages of the barbell strategy is that it doesn't require you to time the market. You don't need to know when gold will peak or when silver will bottom. You don't need to predict the exact month when inflation will accelerate or when the dollar will break. You just need to be positioned before the move happens. And since extreme moves in metals often happen suddenly, triggered by events that no one sees coming, trying to time them is futile. The better approach is to be there, waiting, with the structure in place. Think of it like insurance. You don't buy fire insurance after your house is already burning. You buy it when everything seems fine, when the risk feels abstract. And then if the fire comes, you're covered. If it doesn't, you've paid a small premium for peace of mind. The barbell works the same way. The defensive side is your insurance, the optionality side is your lottery ticket. You hold both, not because you know what will happen, but because you don't. This brings up an important point about cost. Some people look at physical gold or silver and see it as a drag on returns because it doesn't generate income. It just sits there. And in a world obsessed with yield, with dividends, with interest, that feels wrong, but that's backward thinking. The cost of holding gold or silver is the opportunity cost of not holding something that generates cash flow. But what's the cost of not holding it when the crisis comes? What's the cost of watching your portfolio collapse because you were chasing yield in assets that turned out to be toxic? The real cost is the risk you're not hedging. And in the current environment, that risk is enormous. The probability of a major dislocation, currency crisis, debt default, systemic shock is higher than it's been in decades. The cost of not being protected far outweighs the opportunity cost of holding some inert metal. And on the optionality side, the cost is defined. You're putting in a limited amount and you're accepting that it might go to zero. But if it doesn't, if it multiplies, the return on that cost is asymmetric. That's not a drag. That's leverage. Let's also address a common objection. Some people say, if you're so sure about metals, why not go all in? Why bother with the barbell? Why not just load up on silver and silver miners and ride them to the moon? The answer is simple, because you could be wrong about the timing or the magnitude or the specific path. Markets can remain irrational longer than you can remain solvent. If you go all in on a single bet, you're exposed to being shaken out, to being forced to sell at the worst time, to suffering irreversible losses. If the trade doesn't work, the barbell protects you from yourself. It acknowledges uncertainty and builds it into the structure. This is the difference between gambling and investing. Gambling is when you bet everything on one outcome. Investing is when you position for a range of outcomes with asymmetric payoffs. The barbell is investing. All in speculation is gambling. And gambling, even when you're right, is fragile. One bad break, one unexpected event, and you're wiped out. The barbell doesn't wipe out, it endures. Another dimension worth exploring is the role of liquidity. In a crisis, liquidity dries up, assets that were easy to sell suddenly become hard to move, bid-ask spreads widen, buyers disappear. If you need to raise cash in such an environment, you're forced to sell at fire sale prices. The barbell mitigates this risk because your defensive side, physical gold, is always liquid. There's always a market for gold. You might not get the best price, but you can always convert it. And because your defensive side is substantial, You don't need to touch your optionality side in a panic. You can let those positions ride, waiting for the recovery, the rebound, the eventual payoff. This is especially important in metals because the mining stocks and leverage instruments can be highly illiquid in a crash. If you're forced to sell at the bottom, you lock in losses. But if you have the liquidity cushion on the other side, you can hold on, you can wait. And in markets, patience is often the most valuable edge. Now, what about taxes? This is a practical consideration that can't be ignored. In many jurisdictions, physical metals are treated differently from financial assets for tax purposes, sometimes favorably, sometimes not. Capital gains on gold and silver can be taxed at collectibles rates in some countries, which are higher than long-term capital gains on stocks. In other places, certain coins are exempt or receive preferential treatment. You need to understand the rules in your jurisdiction. But here's the key. Tax considerations shouldn't drive your strategy. They should inform it. Don't avoid holding gold because of taxes if holding gold is the right move for risk management. Adjust the structure, optimize where you can, but don't let the tail wag the dog. Similarly, storage and security costs for physical metal are real. Safes, vaults, insurance, these things cost money. But again, weigh that against the risk you're hedging. If you lose 10% of your portfolio in a currency collapse because you didn't hold gold, that dwarfs any storage cost. The costs are trivial compared to the protection. Let's think about scale. The barbell strategy works at any level of wealth. If you have $10,000, you can allocate $7,000 to gold and $3,000 to silver. If you have 10 million, you can allocate 7 million to gold and 3 million to silver and silver plays. The proportions might shift based on your circumstances, but the logic holds. It's not a strategy only for the wealthy or only for the small investor. It's universal because the principles are universal. And here's something else. The barbell can evolve. As you gain more knowledge, more experience, more capital, you can refine it. Maybe you add platinum or palladium on the optionality side. Maybe you explore rare collectible coins that have numismatic value in addition to metal value. Maybe you use more sophisticated instruments, spreads, collars, structured products. The framework can accommodate complexity, but start simple. Build the core structure first. Then, if you want, you can layer on additional strategies. One of the most important things to understand is that the barbell is not a set it and forget it strategy, but it's also not a day trading strategy. It's somewhere in between. You build it deliberately, you monitor it consistently, and you adjust it periodically. Maybe once a quarter, you review the positions, the allocations, the market conditions. You ask, has anything fundamental changed? Are the probabilities different? Do I need to rebalance? Most of the time, the answer will be no. But occasionally, you'll see a moment where action is warranted. And because you've been monitoring, because you have the structure in place, you can act decisively without panic. This brings us to the psychological endurance required. The barbell will test you. There will be long periods where it seems like you're underperforming. Your friends are bragging about their tech stocks. Your colleagues are flipping houses. And you're sitting there with gold bars and silver coins that aren't doing much. This is when most people break. They abandon the structure, chase the performance, and end up buying high and selling low. Don't be that person. Understand that the barbell is built for the long term, for the full cycle. It's not about winning every quarter. It's about surviving the entire arc. And when the cycle turns, when the crisis hits, when the metals move, you'll be vindicated. Not because you were smarter, but because you were prepared. And preparation, not prediction, is the edge that matters. Let me close with this. The world we're living in is not the world of stable growth and predictable returns. It's a world of mounting debts, eroding trust, and accelerating change. In such a world, traditional strategies fail. Balanced portfolios get crushed. Conservative allocations don't conserve, and aggressive bets blow up. The barbell offers a way through. It doesn't promise easy profits or quick wins. It promises resilience and optionality. It promises that you can endure the shocks and capture the opportunities. And in the years ahead, that might be the most valuable promise of all. Build your fortress in gold. Take your shots with silver. Eliminate the mediocre middle. Stay disciplined. Stay patient. And when the system finally breaks, and it will, you'll be ready. Not because you predicted it, but because you prepared for it. That's the power of the barbell. That's how you navigate the unknown without gambling on the unknowable. Thank you for your attention. Now go build your structure.